Moody's brings on-chain credit ratings to Solana for tokenized bonds. Moody's Ratings has extended its token integration engine to Solana, according to a June 17, 2026 report from CoinDesk. The tool lets bond issuers attach Moody's credit assessments directly to tokenized bonds and other fixed-income securities, so the rating travels with the asset on-chain instead of sitting in a separate PDF or terminal. The expansion partners Moody's with Alpha Ledger, a tokenization firm focused on Solana. It follows a municipal bond pilot the agency ran in 2025 and an earlier deployment on the Canton network. Solana is now another settlement layer where a Moody's rating can be read by a smart contract rather than looked up by a human. A rating that moves with the token credit ratings have always lived outside the instrument they describe. An investor buys a bond, then checks a rating on a separate system maintained by the agency. Tokenization breaks that pattern only if the rating moves with the asset. And that is the gap the token integration engine is built to close. With ratings embedded at the token level, a protocol or buyer can verify the credit assessment of a tokenized bond as part of the same on-chain transaction that settles it. Investors need independent credit analysis wherever they transact, and increasingly that's on-chain, said Rajiv Bamra, Moody's head of digital economy strategy, in the report. The practical effect is narrow but real. Tokenized fixed income has grown faster than the trust infrastructure around it. Issuers can mint a bond on a public chain in minutes, but institutional buyers still want the same third-party credit opinion they rely on off-chain. Putting that opinion on-chain removes one reason a large allocator would stay on the sidelines. Solana keeps collecting institutional mandates. The choice of Solana matters for positioning. Moody's already worked with the Canton network, a permissioned chain built for regulated finance. Adding a high-throughput public chain like Solana signals that the agency expects tokenized assets to settle on general-purpose infrastructure, not only on walled garden networks. This lands in a busy stretch for tokenization. Over the past weeks, Coinbase moved 1.1 backed tokenized stocks on-chain with dividends. Mirai Asset tapped Ondo Finance to tokenize its Global X ETF lineup, and the DTCC moved toward a live tokenization demo of real DTC securities. Ratings are the layer that has been missing from most of those launches. A tokenized bond without a rating is a curiosity. A tokenized bond with an embedded investment-grade Moody's assessment is something a pension fund can underwrite. Moody's framed the move against a large forecast. Boston Consulting Group and Ripple have estimated tokenization could reach $18.9 trillion by 2033. That number is a projection, not a current figure, and the real on-chain market today is a tiny fraction of it. Still, it explains why a 100-year-old rating agency is shipping engineering for public blockchains rather than waiting. The link to spending and stablecoin rails. For most readers, this is infrastructure plumbing, but it connects to the consumer side of crypto over time. Tokenized, rated fixed income is the kind of collateral that backs yield-bearing stablecoin products, and the balances some crypto cards draw onto fund spending. The more trustworthy the on-chain bond market becomes, the more comfortably issuers can route real yield into the assets that sit behind a card or a self-custodial wallet. There is a caveat worth stating plainly. An embedded rating verifies credit quality, not the integrity of the chain, the issuer's custody, or the smart contract holding the token. A Moody's stamp on-chain does not make a tokenized bond risk-free any more than a rating made mortgage-backed securities safe in 2008. It lowers one specific friction, which is independent credit assessment, and leaves the rest of the diligence to the buyer.